Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. This week, we're doing something unique with the podcast, and then I'm offering a series of interview previews for interviews that will take place in the DIY Investing Summit next week, which begins Monday, January 23rd. And the summit is being put on in partnership between Seeking Alpha and Investor in the Family, and each one of these interview previews stands alone in its value, but it gives you a glimpse of what the rest of the interview may be like, as well as the rest of the summit, which overall has 25 interviews from some of the top investors from Seeking Alpha. Registration for the summit is free for a limited time, so be sure and check it out at DIYinvestingsummit.com. That's DIYinvestingsummit.com, or you can check out any of the links in the show notes or the article. And I hope you enjoy this second clip from an interview with Chris DeMuth. So how are you positioning yourself for the start of 2017? Again, we're recording this in December of 2016, but how are you positioning yourself for the start of 2017? What are you excited about? What has you concerned?
Well, I'm apt to say something that could embarrass myself in the future. I sure as heck hope I'm not going to say anything that embarrasses myself in the past by the time this is recorded. So hopefully I can at least come up with something that isn't a calamity between now and the time that it's public.
If it is, I'll offer you the chance to re-record.
I would say that it could be like a choose your own adventure. We'll have a couple different versions. I'll suggest both being long and short, and then you can just go to whatever version is
done.
Most prescient. But I would say on the event-driven side, the type of events we are looking towards in a March 2009 can be a very soft catalyst, highly reliant on fundamental valuation. In a world of today, very much closer to the top than the bottom of a credit and equity cycle, I'm looking at ideas with hard catalysts. So I think this is a very, very good regulatory environment. I am very interested in a number of situations with substantial antitrust risk. We have a large position in Rite-Aid, for example. One idea that is my favorite merger arb opportunity for 2017, but we have a large exposure to that complex antitrust situation. They're in the process of being acquired by Walgreens. So that's one example. And then the other one that I would mention that is pretty indicative of how I'm approaching the new year is that as we've gotten the cash back and the equity consideration from Ocean Shore, so we're no longer Ocean Shore shareholders, the successor to that opportunity is another bank called BNC, ticker BNCC, in North Dakota of all places. And it is a very inexpensive bank. It is underscaled. It should be acquired by a regional consolidator. It is worth probably somewhere between $35 and $40 per share to a buyer. This year is trading much lower, and we've held it for a little while here, but it still costs kind of mid-20s, and it'll be mid-30s shortly, I think, if we get a deal, which we should. And then a third example I'd throw out, I'm full of examples, I guess, is BOBE Evans, a large position of ours, a significant investment. They are known for their restaurants. Their management thinks of them in terms of their restaurants, but the gem within BOBE Evans is their prepared sides, which you can get in the grocery stores. It has been focused on by the management, by the market. It really should be a separate company, and it is something that could be consolidated. They're working with advisors, and it should be BOBE Evans should be sold in whole or in part. Parts probably make more sense. It also has extremely valuable real estate, and if the market kind of properly put together the real estate with the restaurants, with the prepared sides, it would be worth, kind of upper 50s as a standalone, upper 60s to buyers if these assets were really optimized, and that they cost between $52 and $53 last I checked per share. So that's, I think, 3 examples, just kind of pulling them out of the things that are on my mind today and in my portfolio today that I think are really priced incorrectly.
And you said with the BOBE Evans, you said each of the 2 different companies, if they spun off, would be worth upper 50s. Is that correct?
Oh, no. The upper 50s is just if you combine the sum of the parts.
Gotcha.
But that's the fundamental standalone value of the assets, upper 50s, including a control premium. My hope and expectation is there's another $10 per share, something like that.
Awesome. And just to be clear, you said you're looking for ideas with hard catalysts as opposed to soft catalysts. And I guess a hard catalyst, that would mean, what do you mean by that, just to be clear?
Sure. In every case, we're looking for a pricing failure or market efficiency. We're always looking for what the true odds are and how they differ from the market implied probability. Now, where does that edge or advantage play come from? It comes from a combination of judgment about value and information. And as the markets get more and more expensive, we demand a higher and higher threshold for actual information as opposed to just a generalized sense of value. When the markets are very inexpensive, we can look to areas that are more kind of thematic and say, oh, I'm happy to be broadly exposed. We think we get $9 per share per Rite-Aid share, and we think we get that within the next couple months. And we have a reason to think that. That's based upon information, not judgment. Judgment might kind of expand upon that, but our threshold for what kind of information we need is much higher right now, because it wouldn't be that surprising to have a double-digit market decline in the near future. And I want a portfolio of ideas, including long ideas, that would tolerate that well.
Great. And you just mentioned the idea of a double-digit market decline in the near future. And obviously, and we'll talk about this a little bit more in some questions coming up. And no one has a crystal ball. And I know that I'm sure you don't like making any hard and fast predictions. But do you have significant concern that could take place in 2017? Or is that not a question you even like to entertain?
My day job is trying to understand businesses bottom up. My extracurricular hobbies include thinking about such things. So I guess I'm a worrier by nature, and it seems entirely possible. I think that it's more something that it is an environment that I would like to be comfortable with my cash and with my position sizing in order to be opportunistic. And the way I think about it is the more and more exposure I get, the less and less flexibility I have. And I always want a combination of being able to maximally profit from my current ideas and to be maximally flexible with my potential ideas within my opportunity set. The way I think about it is maximizing my profits plus loss plus opportunity. And so if you kind of think about profit P&L, an opportunity set, that third aspect kind of weights down how big I can be in things so that I can comfortably, easily double down a few times if something goes wrong, or if just everything goes wrong and there's new opportunities later in the year, that we can be nimble about that. The way I think about it is to always be more liquid than my marginal counterparty, so that when there's a real liquidity problem, especially in the kind of ideas that are popular amongst hedge funds, that we can be predatory in that situation. So I have no idea what's going to happen, and am fairly confident that nobody does.
Sure.
But I can play around with scenarios such that we are comfortable with how we're situated, regardless of what happens.
And just to get that clear, you said maximize profit, and what were the other two parts of that equation?
Oh, just net of losses, and stay nimble about our opportunity set. Right, because taking our best ideas and fully sizing them, having no cash, even using leverage, would be our best dollar-weighted expectancy today. But we don't do that. We don't come close to that. And the reason is because we also have a certain amount of confidence in our opportunity set that might get bigger in the months ahead. So that's always kind of the push and pull of how we size our positions. we have no particular reason to think that the opportunity set I'm looking at today is unique or special or even better than average. It's probably somewhat worse than average.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.